Welcome back to the deep dive. We're here to give you those essential insights, the ones you need to be genuinely well informed. Today, we're tackling a big one. Building wealth through real estate sparks a lot of dreams, but also maybe some misconceptions. I think many people figure, okay, buy a house, wait, prices go up. Simple. But the source material we're digging into today really challenges that idea. It's much more involved.
Yeah, the core idea that jumps out is that smart investors, the ones who really build wealth, they don't rely on luck. It's about understanding, really understanding, and using strategies across 5 key areas. And if you skip one, well, that could cost you big time. So think of this as like a blueprint, a crucial guide.
Exactly. And what's so useful about breaking it down into these 5 pillars is, well, it makes a huge, often overwhelming topic feel more manageable, actionable even. There's just so much info out there, right? It's easy to get swamped. These pillars give you a clear roadmap, helps you focus where it really matters, avoid that, information overload. It's about building a solid strategy, not just crossing your fingers. Right, a solid strategy. That's the goal. So our mission today, let's unpack these 5 essential pillars, pull out the most important bits, the real nuggets of knowledge from our sources. We want to show you how they all connect, how they build on each other. Okay, let's unpack this. First up, the absolute classic. Pillar 1, location is everything. Everyone says it, but our source has this great line: you can fix a house, but not its location. Powerful, right?
It really is. It's a cliche because it's fundamentally true.
But this deep dive, it pushes past just, good schools or safe streets. What are those less obvious signs? The forward-looking things that show a location is really set for growth.
Ah, okay, that's where it gets interesting. It's not just about now, it's about next. The source really hammers this. Look for areas where people are moving in, not out. Simple idea, but you got to look deeper. What are the drivers of that movement? Think big things like major companies setting up shop, universities expanding, big infrastructure projects like new train lines.
Anchors for future demand, you mean?
Exactly. These aren't just, a new cafe popping up. These signal real long-term economic shifts, sustained demand for housing. The guide even points out a property in, say, a gentrifying area with a strong 5-year outlook driven by these anchors. That can often outperform one in a neighborhood that's already prime, but maybe economically flat. You're looking at the trajectory, not just a snapshot.
So it's like being a trend forecaster for neighborhoods, spotting those underlying economic engines, not just, well, how nice the houses look right now.
Precisely.
Which leads right to this key question the source poses, and it's one for you listening to really consider. Would I want to live here 5 years from now? If you can answer that yes, based on those solid growth signs we talked about, well, then you're probably on the right path to finding a genuinely strong location for the long haul.
It cuts right through the noise, that question.
Okay, so you found that prime location. What's next? That brings us to pillar number 2. Choose the right property. Now, the classic advice, and our source mentions it too, is buy the worst house in the best neighborhood. It's not just a saying, is it? It's about forcing appreciation. The good location sets the value floor, and fixing up an outdated place, well, that's how you build equity. But what kinds of properties does the guide suggest looking at? What are the trade-offs involved?
Yeah, the source breaks it down into 2 main camps, really. Each fits a different type of investor. First, you've got your turnkey properties. These are basically move-in or rent-out ready. Renovated, maybe even tenanted already.
Sounds easy.
It is easy. That's the appeal. Income starts flowing almost right away. Minimal hassle up front. But that convenience costs you. They're pricier, naturally, which can squeeze your overall return.
Okay, makes sense. What's the alternative?
The alternative is the distressed property. This is your classic worst house scenario. Think foreclosures, short sales, places needing serious work. They're usually cheaper, selling below market because they need that work. So the potential for higher returns is definitely there. You force that appreciation through the renovation.
But there's a catch, I'm guessing.
Oh yeah, a big one. The source is emphatic. This strategy absolutely requires the right team. You need reliable contractors, maybe designers, project managers you trust completely, people who know what they're doing.
Ah, the team aspect. Crucial.
Totally. What's fascinating here isn't that one type is better. It's about matching the property to you, your risk appetite, your cash on hand, and critically, whether you have that solid support network. Because without that team, that distressed property can turn into a nightmare, a real money pit.
Yeah, I can see that. Aligning the property with your own capacity, your resources, that sounds key. Because a fixer-upper with no reliable help, nightmare indeed. All right, moving on. Pillar 3. This one's huge, non-negotiable really. Know your numbers. And we're talking way beyond just rent minus mortgage.
Yep.
That's just scratching the surface.
Absolutely. That's the bare minimum.
So what are some of those costs that people, especially new investors, tend to forget or maybe underestimate?
Well, the source gives a pretty thorough checklist. You absolutely have to account for property taxes, and those can fluctuate,
Oh,
remember?
right.
Insurance. Essential protection, but a real cost. Repairs, things will break, often at the worst time. Maintenance is ongoing. Vacancies, you won't have a tenant 100% of the time. You need to budget for those empty months.
Good point. Lost income.
And management fees, if you hire a pro, which we'll get to why that's often smart later. But here's one that often gets totally missed. Even if you manage it yourself, your time isn't free.
Ah, the opportunity cost.
Exactly. Every hour you spend dealing with tenant issues, fixing a leaky faucet, doing paperwork, that's time you could be using for something else. Your job, another investment, family, whatever. That lost potential, that's a real cost too. Our source suggests aiming for at least a 7% return after all these costs are factored in. And crucially, plan for surprises. Have a contingency fund.
That 7% number, why that specifically?
Well, if we connect this to the bigger picture, the source positions that 7% as a kind of baseline. It's the minimum return post-expenses and risk-adjusted that makes real estate competitive with other investments, especially given it's not very liquid and takes effort to manage. Below that, the guide implies maybe the risk and hassle aren't worth the reward compared to, say, index funds.
Okay, that 7% target is a really practical takeaway. It gives people something concrete to aim for with that important context about risk and effort and planning for surprises. Yes, always budget for the unexpected furnace failure. Now, here's where it gets really interesting. A lot of people focus on the purchase and the cash flow, but they might miss the bigger financial picture, which leads us straight into Pillar 4. Use tax benefits wisely. Our guide says this isn't just a nice bonus, it's a powerful edge real estate offers, something that can seriously boost your bottom line. What are we talking about here? What are those tax advantages?
Yeah, the tax code is, well, it's complex. But real estate definitely has some unique perks. The source highlights a few key deductible items. Obviously, there's mortgage interest. That's usually a big one. But then there's depreciation. This is kind of amazing from an accounting standpoint.
How does that work exactly?
It lets you deduct a portion of the property's value, the building part, not the land, on paper each year. It reflects wear and tear, theoretically. So it reduces your taxable income, even if the property is actually going up in market value. It's a major reason real estate can generate such good after-tax returns.
A paper loss that saves you real money?
Pretty much.
Yeah.
And then, of course, repairs, operating expenses, those offset your rental income too. But, and this is crucial, navigating all this effectively, that takes expertise. Which raises an important question, right? You might be great at finding deals, but do you know the latest tax laws inside and out? Probably not.
Unlikely for most people.
Exactly. So the source is crystal clear. A real estate savvy tax pro can save you thousands. Seriously. They know how to structure things, track everything properly, make sure you claim every single legal deduction. They turn tax planning from a chore into a real financial lever.
That's such good advice. Trying to DIY complex real estate taxes sounds risky. You could leave money on the table, or worse, get into trouble.
For sure.
Which actually flows nicely into our fifth and final pillar. Property management is key. Now, the source says this pillar protects two critical assets for an investor. We usually think about protecting the property itself, the financial asset. What's the other asset?
Your time.
Ah, okay. Makes sense.
Yes, good management protects the property and its income, obviously. But it also protects your time, which, let's face it, is incredibly valuable, and you can't get more of it. The source details what a pro manager does. Handles tenants, repairs, and legal issues. Just think about all that entails. Finding good tenants, screening them properly, that's huge. Collecting rent consistently. Coordinating repairs, when the plumbing goes at 2 a.m. on a Sunday. Handling leases. Navigating tricky landlord-tenant laws, which vary everywhere.
Yeah, that sounds like a full-time job in itself.
It absolutely can be, and often stressful. What's fascinating here is how good management basically transforms all those potential problems into smooth operations. It frees you up. You can focus on finding the next deal or your career or just living your life instead of being constantly pulled into the weeds of property issues. And at the same time, it protects your investment, making sure the place is maintained, tenants are happy and paying, legal stuff is buttoned up. It maximizes returns and minimizes those headaches.
Totally. Your time is finite. If you're always putting out fires, unclogging toilets, chasing rent, how do you even scale? How do you enjoy the benefits?
Exactly. It's hard to build an empire if you're the chief plumber and rent collector.
So when we wrap all these five pillars together, location, property choice, numbers, taxes, management, what does this all really mean? What's the big picture for someone wanting to build wealth in real estate?
Well, I think what it means is this deep dive has given us a really clear, actionable roadmap. It goes way beyond just buy low, sell high. We've seen that building real wealth isn't passive. It takes active, smart decisions across all five areas, understanding that real growth potential and the location, choosing the right property for your situation, really knowing all the numbers, not just the easy ones, using those tax advantages strategically, and making sure you have solid property management, whether it's you or a pro. That's it. They all interlock. Each
Yeah.
pillar supports the others. It creates this integrated, much more resilient strategy. And by understanding these five areas, by really applying them, you move past just hoping for the best. You're not just a participant, you're strategically building wealth with intention. That's how you become truly well-informed in this space, making decisions that count for your financial future.
Couldn't agree more. That's what we strive for here. Thank you so much for joining us on this deep dive into building real estate wealth. It's been really illuminating digging into those layers of strategy.
My pleasure. It's a fascinating topic.
And for you listening, as you go about your day, maybe thinking about your own goals, here's a final thought to chew on. Considering these five pillars location, property type, numbers, taxes, management not just as separate items, but as a connected system, how might that change the way you even look at a neighborhood or a listing online? Knowing you're not just potentially buying some bricks and mortar, but investing in a future that you can actively shape through these informed strategic choices instead of just passively waiting, something to think about. We'll see you next time on The Deep Dive.